to the Smart Property Investment Show with your host, Phil Tarrant.
G'day everyone, Phil Tarrant here. How you going? Crazy week this week. We're at the back of some madness. I've just been down in Canberra for 3 days with all the politicians and other people involved in the budget. A lot of functions, a lot of talking, a lot of rhetoric. I think I'm pretty filled in on what this budget's all about, and my head's still spinning with it all. But so we've had that. We've had a rate cut. The RBA pushed down our rates to all-time low of 1.75%. There's also been a lot of noise around bank profits as well. Some of them are smashing it. Some of them are doing not as well as what they thought they'd be doing, but they're still killing it. Today, I've got two guests on the show, and I just want to have a chat about just what's been going on this week and also get some insights from a property investor called Michael Shah, who's come in and joined us to just regale in his experience and his thoughts on what's gone on this week, but also his story as a property investor. Michael, welcome to the show.
Thank you, Phil. Good to be here.
Mate, thanks for coming in. I've also got our head of editorial across our mortgages and real estate products, James Mitchell. Mate, how you going? Welcome back.
Thanks, Phil.
So you're the bloke here at Sterling Publishing.
Yeah.
That's been writing up until all hours of the evening.
This week especially.
About the budget, which was handed out on Tuesday night.
That's right. So it's been a busy week with news across mortgages and real estate. Tuesday, obviously, we had a rate cut from the RBA as well, which was sort of a 50-50, but then they decided to drop it to 1.75, as you said. Immediately after that, we had NAB come out. They were the first major bank to cut rates. They passed on the full cut. I think one of the regionals came out after that, and then within 48 hours, we've had, I think it's about 13 different lenders who have cut rates. Not all of them have passed it on. Obviously, they've got some like funding pressures and stuff like that, but it's been a busy week for sure. And then we've had the major banks come out with their profits, which are always, front page news here. ANZ didn't do too well. I think the profits were actually down 24%. So they didn't actually pass on the full rate cut. Others did. But it'd be interesting to get an investor's thoughts on, what all this noise actually means when it comes to reality. There's a lot of noise made about the budget and that sort of stuff, but when it all comes down to brass tacks, how does it actually impact?
And this is the reason why we got Michael in. So Michael, I want to get you back on the show in a couple of months' time because I want to talk to you. I want to look at your portfolio, and I know it's got a really good story, and you've been in smart property investment before, talking about that, so I really want to touch on that. But for the moment, what James was just saying, what does an investor think about all this? And I invest in property. I keep abreast of all this stuff.
Yeah.
And sitting down in Canberra over the last couple of days, I think about the budget and all the stuff that's been released in it, and a couple of standout things. In terms of tax rates for SMEs up to breaks up until 10 million. Increase a bracket for over 80,000 for. If you tax, all this sort of stuff. And I sit there and think, okay, well, so what? What does this actually mean? Is this more dollars in my pocket? The one thing I did like about the budget is that they didn't get rid of negative gearing, which was a big plus. And I think investors all over the country have gone absolutely brilliant.
That's right.
I'm happy about that. That's my take. It's not really going to impact me that much. The rate cut, 1.75%, hopefully, it's going to be passed down to my actual mortgages, and I think that's happening right now. What's all this stuff mean to you?
I guess from my perspective, in terms of as an investor, it doesn't change too many things. I think that the rate cut, 0.25, that's more of a bonus. I think that if your investment decisions was based on 0.25 of a basis point, then it could be a little bit shaky. Personally, it would just be a few extra dollars savings from interest rates. In terms of the budget, I think the big one for all the investors out there was negative gearing. I know that personally I go for positively geared properties, but with negative gearing, that once you add in the depreciation reports or the expenses, a lot of stuff also becomes negative when you do the tax return. So from that perspective, obviously quite happy around that it didn't get changed.
Yeah, I think a lot of people are, because I sat in the Treasurer's post-budget speech. It was at a breakfast on the lunch on the Wednesday that the National Press Club put on, and he spoke about the type of people who the biggest negative gearers, and a lot of them are the guys earning under $80,000 a year. And he said, it was a really interesting stat, and it stood out for me. He said that 1 in 4 police people have negative geared property. Or was a
Yeah.
stat like that? It's absolutely, the type of people, this whole rhetoric around, negative gearing being, incentive for the rich and all this sort of stuff. Negative gearing impacts just your every average Aussie who's just trying to invest for their future, and they're building wealth through property, but at the same time they're providing affordable housing for people through rents as well. So I think everyone was happy that negative gearing is staying.
Yeah, for sure.
The noise that you get, your chats on the phone, James. Is that a common sentiment?
Oh no, absolutely.
Yeah,
absolutely. I mean, everything that comes through from the HIA and the Property Council and all those sort of industry bodies is very positive about what's happened with the budget. It's been interesting. I mean, it's become so political. You know what I mean? It's I think one thing which is really missed is that the majority of Australians are actually pretty aspirational. And they want to own their own home and they want to invest in property and they want to get ahead. And just as you said with that statistic, negative gearing is not for the elite, the cream of the crop, the wealthy, to reduce the amount of tax they pay. It's actually an important investment strategy for the majority of people in the market.
Interesting. And Michael, so your story, mate, you're a property investor, and you have about 14 properties in your portfolio.
That's right. Yeah.
Which we'll talk about next time we get you on the show. You've got an interesting story in terms of you've built those properties up over a period of time working in corporate life, and now you've ditched corporate life.
Yeah.
And now you're
Become
a mortgage broker.
That's right.
Okay, mate, tell me a little bit about that story. How'd that happen?
I guess everyone that goes into property investing, you've got a goal, something that you want to achieve. And for me, that was to quit work. I hated my corporate role. And
what did you do? What's the job?
Probably shouldn't be saying this. I mean, I was in market research.
Yeah.
And,
So looking at spreadsheets all day.
Yeah, exactly. Yeah. I mean, I was in online advertising, market research. I would say first couple of years I loved it. But after a while, towards the end, because I was in corporate for 10 years, you get a little bit jaded towards the end. You think, what other things are out there? And I think, always have those aspirations of finding something that will lead you to something. And you'll have all these crazy ideas, what if you invented the next Facebook, blah, blah, blah. For me, it was actually in property investing. So I came across property investing about 3 years ago. And at that time, I had 2 properties. And just speaking to the right people, using the right strategies, then I managed to quit corporate. But from the very first day that I started property investing, that was my main goal. And the reason why I wanted to quit corporate, funnily enough, was I really like touch football. I just want to spend more time training, playing touch football.
Okay.
Fair enough.
Yeah.
You're obviously still playing touch footy.
Yeah,
now.
and that's how I did my knee injury. And hence the surgery in 1 week's time.
Fair enough.
So you're a mortgage broker now. You've
Yep.
been doing it for a year.
Yep.
What's your business called?
It's called Mortgage Channel.
Okay. Whereabouts are you based?
So at the moment, I'm based on the Gold Coast,
Yep.
but the majority of my clients are all from Sydney.
Okay.
So I guess my niche market is Sydney investors buying Brisbane.
Okay. Which everyone seems to be doing these days.
Yeah, exactly. So that will account for probably about 70-80% of my investors.
And most of the people who are your clients in Sydney, how do they find you?
Actually, the majority of them came through a property forum called Summersoft
Okay.
and Property Chat. You guys
Which closed down now, Summersoft, isn't it? It's
That's
been
right.
archived,
So
yeah.
that closed down, that morphed across to Property Chat. So the initial client base was all from that forum because I'm quite active, sharing my story and sharing, areas that I'm buying, tips around that. And then after that, it's just exploded through word of mouth.
So most of the people buying investment property up in Brisbane, so I'm talking to you as you're a mortgage broker now, not an investor.
Yeah.
Are they sort of buying via buyer's agents, or are a lot of people just doing it solo? How's it working at the moment?
I guess it really depends on the individual. If you're very, very busy with your job, you don't have time to come up there and have a look, and you're not that interested in finding a property yourself, then by all means use a buyer's agent.
Yeah.
On the flip side of it, if you have an interest in finding those deals yourself, and also you've got the time to come up there, fly up there and have a look, then by all means those people are buying through themselves. A lot of them actually, funnily enough, every Saturday, I've got 3, 4, 5 clients flying up from Sydney, and we just go around looking at properties together.
So you pick them up at the airport, do you?
I don't pick them up at the airport, but then we meet at the properties, and we just spend the whole day going through open homes.
And who are these people? Are they just
normal
average guys, average negative gearers, yeah.
Exactly, exactly, yeah.
And like couples, young people or old
singles,
people.
Yeah, it will be a broad range. I've got some young investors early in their 20s all the way up to 65. So it's definitely a broad mix. If there was a cross-section of just your average Australian investor, I reckon most of them will be it.
Are they pretty green? So do they come up there going, oh, I listened to the Smart Property Investment Show and they reckon that's investing in, I imagine it's all around the Logan area, Ipswich,
That's
all that
right.
sort of stuff.
Yeah,
right?
Logan, up north, around Strathpine, those types of areas.
And they go, I've been told it's really good investment up here, so I want to buy an investment property up here. Or like, what's the level of sophistication?
Yeah, and I think that's the key. It's, I mean, some of them have invested before, or there's some other people that they want to invest, but they've seen the Sydney property prices and they're like, well, this isn't going to work. They still want to do property investing, so they look at different areas, and it's all a broad mix. But the one thing that's pretty common is it's their first time buying interstate.
Okay.
And for someone buying interstate for the first time, it's actually quite daunting. So I think for someone to be on the ground there, that can guide them a little bit, because the negotiation and also the buying process is very, very different to New South Wales. Also, in terms of how you work with the agents, with negotiating with building and pest, a little bit different again. And also the areas, it's not quite like Sydney, where I reckon in Sydney you throw a dartboard. Where you buy, you're going to do generally okay if you bought 2 or 3 years ago. But in Brisbane, because the population isn't quite there, you need to be a little bit more pickier with your location selection. So I think all of those things put together, they need a fair bit of work just to learn the areas to buy in Brisbane, and then they'll come up there and then we'll go through the properties together. But in saying that, even that process doesn't take that long. I think that mechanical side of property investing, once you know it, you pick it up very, very quickly. It's an emotional side of property investing that takes a little bit longer.
So put you on the spot. If
Yep.
I'm a Sydney investor or a Melbourne investor or wherever, and I'm looking to invest up in Brizzy, or I'm looking to invest outside of my home state or city for the first time,
Yep.
what are the 3 musts that you must think about before you go and do that? What are the essential things to get right before you invest interstate?
I would say that we'll talk about Brisbane in particular, because I know that a little bit
Yeah.
better. I would say around Brisbane is definitely know the demographics and the target demand there. I think that particularly, I mean, even for instance, an area like Logan, the demographic there is a little bit different to say north of Brisbane. So the types of property that you're buying needs to meet the target market. So in Logan, there's a lot of extended families, larger families. So if you can buy a product that targets those types of households, you can then get a lot higher yield. The other thing around Brisbane everyone knows is of the flooding. So make sure you check the flood maps, know exactly which pockets, because every pocket there, certain parts of it may flood. So it's not really about is one suburb good or another suburb good. It's more so in that particular suburb, what's the pockets that's good because of flooding, and that becomes more apparent. And I'll probably say the other one with new investors coming up to Brisbane, the first thing they say is, can you send me the contract of the property like you do in New South Wales? But the contract in Brisbane, it's a template contract. It's the same across all the properties.
Yeah.
So then the buying process is a little bit different. So just getting your head around that.
So the extent of your services up there,
Yep.
so you're a mortgage broker, so you help
Yep.
them finance these properties. You sort of going above and beyond and sort of showing them around and taking place. Is that just you being a good broker and offering good service, or do you sort of get involved in the buying side as well?
I don't get involved in the buying side of things, so I'm not a buyer's agent.
Yeah.
I would say mortgage brokers all need to differentiate themselves in a certain way. It's a very easy to get into industry. Basically, you do a 5-day course, you find, accreditation, and then you go through an aggregator and boom, you're a mortgage broker. So I think all mortgage brokers need to differentiate themselves in a certain way. And this kind of combines to what has worked for me and what I find successful. So I believe in it.
Okay.
And why not just help my investors? Because my goal is if I can make them a better investor,
Yeah.
and the properties that they're buying is better, then for their long-term financial goals, it's going to be heaps better.
Yeah.
Also for my business, it's going to be better. So for each of my clients, I spend a lot of time taking them through that process.
Yeah.
And at the end of it, they're a lot savvier investors as opposed to someone just came, just to a bank and then got their loan through the bank.
So you've been a broker for a year now.
That's right, yeah.
I mean, it's obviously been a year of a lot of change in terms of the bank's risk appetite and that sort
That's
of thing.
right, yeah.
So, how did you sort of navigate that? You know what I mean? You sort of came into the profession at a time when there's been these radical changes, and then you're pulling back with investor and tweaking their policies. Has there been a lot to learn?
Yeah, it's been difficult. every week when I first started, there was a different set of changes. So when you were modeling out these property portfolios, what worked one week didn't work the next week because of all these drastic changes. So I was saying the thing that helped me a lot was I had a really good mentor who guided me through that process, kind of then said, okay, because of these changes, these are the things that are possible. And I think once then you're in the industry every single day, then, I mean, you can definitely still build a decent portfolio with a certain limited income. It's not nearly as much it was before, but it can still definitely be done.
Yeah. It was interesting, you know, when we just started the show this morning, we were talking about the busy week that's been, and the results from NAB and Westpac and ANZ that have come out. And I actually managed to get on the phone to the CEO of ANZ, Shane Elliott, and ask him a question about mortgage brokers and about their home lending business. And it was quite a surprise from the CEO of a major bank to come out and say, you know, brokers are incredibly important for them. That's where their customers are going. You know, that's why while they may not have been as competitive on price, turnaround times and getting the deal done as quick as possible and as efficiently as possible is what, you know, they've been working on. And it's it was also interesting hearing them talk about, you know, capital changes and things like that. And they were said, you know, there might be these international regulations, you know, which we need to meet. But in Australia, investor loans are not necessarily riskier than owner-occupied loans. They said, in actual fact, they found that they're less risky in some instances. So it's pretty bold comments, you know, to come out of a bank like the ANZ.
It's good to see, you know, they're firmly behind the broker channel, and I think the level of investors in the market right now, and that's decreased a little bit because of APRA changes and serviceability requirement from the banks, but you know, investors are a mainstay of the property market, and you know, investors by and large, they might make a couple of mistakes on the way, but they get pretty savvy pretty quickly. And you probably see this in the investors coming up to Brisbane. How many of them arrive there at Gold Coast Airport or Brisbane Airport with a pre-approval in their back pocket?
Actually, for most of my guys, we don't do pre-approvals. We do a whole bunch of modelling up front. And if they're good to buy, then we generally say go and buy. If it's at auction, we'll do a pre-approval, or if the deal is very tight, then you'll do a pre-approval. Most brokers, before they submit the deal, they'll know whether it's passing or not. Yeah. So if it's tight, sure, go down that path. But the other thing that you find too is, I think there was a statistic around that only 40% of pre-approvals went through. So for the rest of them that didn't take place in the 3 months where the pre-approval was valid, that's a wasted credit hit. And if I've got investors coming in buying multiple properties...
So just stick on that point. Can you explain to our listeners what you mean by that's a credit hit?
Okay. So every time you lodge an application with the bank, when they assess that loan, they'll then look at your credit file. So look at if you've had any credit card defaults, any phone bill issues, how many loans that you've asked for, how many loans that went through, and so on and so forth. So if you're going down the property investment path, keeping a good, clean credit file is paramount. Because if you don't have a good credit file, the loan that would have got passed previously, but because you've got some bad credit there, may actually fail.
If you go out and get a whole bunch of pre-approvals from different lenders, or, you know, you keep getting pre-approvals and they expire, get another one expires, so that all sits on your credit file.
Correct.
So even if you're not taking out these financial products and taking on more debt, does the bank look at that negatively, that you're continually looking for credit and getting approved for credit and not taking it on?
Yeah, they do. And especially when you submit a loan, what the bank assessor will actually come to the mortgage brokers is, can you please explain all of these credit hits? And if you've got all of these credit hits leading to nowhere, then they start to ask questions. So that's the main thing, that if you are going for a loan, make sure that that's a loan that you're going to get. If you are going to shop around, make sure either the banker or your mortgage broker doesn't hit your credit file. That's very, very important. Especially, I mean, if you're just going to buy 1 or 2 properties, doesn't matter so much. But if you're looking to build a portfolio in that time, to equity top-ups, you know, refinances, to get money to move on to other deals, then managing your credit file becomes very important.
I think it's a really good point. My conversations with investors, a lot of them are focused on buying the property and the glamour and excitement and the prestige and all this stuff, which is largely irrelevant. You know, it's an unemotional financial purchase to help you create wealth. The financial component of it is the bit that most people don't want. They want the property without the debt, but you know, you need it. By and large, the sophistication of investors initially, I think it's pretty, into financial sophistication is pretty low, and it's a bit of an afterthought, the mortgage. So that's really good counsel in terms of...
And then also, I guess in my journey, it was the same. Like in my early days, I went through a couple of mortgage brokers. In hindsight, they didn't structure me properly until I came across my mentor, Rolf.
Yep.
And it was actually through that I realised how important it was. And just seeing what he did for me and the ramifications of that made me feel that to an investor, that's probably the one area that you could affect the most. It's similar to yourself, Phil, that once you've invested in quite a few properties, there's always deals out there. You know, a deal of a lifetime comes around each week.
Yeah.
At the end of the day, it's do you have the finances to secure that deal?
With your mortgage broker hat on, so the banks have dropped, well, the RBA has dropped the interest rate, and a lot of the banks have followed on, passed on the full cuts. Some, not so many. ANZ didn't.
0.19,
Yep, because they didn't get the profit they wanted. But you know, there's still plenty of margin in mortgages. But what's your sort of recommendation to property investors, whether they use a broker or go directly to the bank? Should they be getting on the telephone, checking out, you know, whether their rates moved or asking for discounts? What's the best approach?
I would say in terms of the rates, probably if they're looking to get rate reductions, the best time to do that, from my experience, is when you're getting a new loan or a new top up. Because if you bring some more business to the bank, they're a lot more willing to negotiate at that point in time. But if the rates moved or you haven't done anything in addition or to your current commitments, asking for rate reductions, the reductions that I see coming through from the banks aren't nearly as attractive as opposed to new business. So it could even be sometimes just topping up like $60,000, $100,000, just a small equity top up can get your entire portfolio repriced. So if it's that, then I'll definitely advertise to go down that.
So Mike, with the lender, is it a sort of coercion thing? Do you say, if you don't match this rate, I'm going to move my portfolio, move my mortgage?
Yeah, I mean, a little bit of that. I think if you can provide evidence, so anytime you submit a pricing to a bank, they always want to see what the competitor is giving. And depending on the flavour of the week, it may be that, say, for instance, CBA really wants to pull business away from Suncorp. So if you kind of say the right banks and say the right rates, they're a bit more willing to give it to you. Now, a mortgage broker that's at the coalface, that's submitting all of these pricing deals, will have a better idea of that. Or you can go on online forums, see what other people are getting. But if you can just be on the ball in terms of what's actually being negotiated, then you'll be able to get better rates.
And going back to the madness of this week, so federal budget, interest rate cut, lowest in history, 1.75%.
I think so, yep.
Plus the banks announcing all their profits. As an investor, and I'm an investor, but all our listeners as well, what should I be doing? If you're going to give one tip about, here's all this stuff, what should I be doing now to either capitalise on this or educate myself on this, or is there anything I really need to do because of all this happening? Or if I don't do anything, it doesn't matter. What's sort of, to summarise, what's the thing? What's your one tip for investors?
I would say that looking at the rate drop and then going to the lenders and just seeing what's being passed on. But then also after that, speaking to whoever your banker or your mortgage broker is and just seeing what other options there are. I think it's a time that you can start to reassess your portfolio a little bit, kind of work out the cash flow. But I would say a lot of property investors, go out there and just look at your cash flow, just with this drop, see how it works out, and then look at and then speak to your financial contact what other things can be done around it.
So other than going to smartpropertyinvestment.com.au for all the information you need, is it incumbent, do you reckon, on the investor to be proactive, to call their mortgage broker saying, what do I do, what's going on? Because not all mortgage brokers will call their clients.
Yeah, no, I mean, I think it's a bit of both.
Yeah, take control.
Yeah, take control. I think, I would say depending on who your contact is definitely start to take some control, because, I mean, another saying that I have at the end of the day is you've got your best interest. So, if it's going to save you X basis points there, then you definitely should be pushing for
more money in your back pocket.
Yeah, that's right. And even if the cash flow just improves by, 0.25 on a decent sized portfolio, I mean, that's actually a sizable saving there. So whether that can be used to other things can definitely help your cash flow.
Nice one. Michael, mate, let's get you in a couple of months' time.
Beautiful.
I really want to chat about your 14 property portfolio. I reckon it's pretty exciting. But appreciate your time today, James, as always, mate.
Cheers, Phil.
It was good to see you. Remember to check us out at smartpropertyinvestment.com.au. You can check us out at Facebook, Twitter and all that sort of stuff. If you'd like to follow me on Twitter, Philip Tarrant, that's double L, Tarrant. And thanks for tuning in. Keep those reviews coming on the iTunes. It's good to know that what we're talking about is of value, isn't it, James?
Absolutely.
Nice one. Goodbye. See ya.
Cheers.
Goodbye.